Marketplace Books and Traders Library is proud to present the Trade Secrets video series. When you're looking for new ways to boost your trading returns, these best-selling resources will give you the tactics, strategies, and ideas that transform your trading. Featuring some of the most highly respected educators in the industry, you will get the knowledge of professionals like Kathy Lean, author of Day Trading the Currency Market, in the Insider's Guide to Forex Trading.
You don't need necessarily to trade this on a minute-by-minute, tick-by-tick basis, because you can trade the currency market in a much more relaxed mode and still take advantage of these major trends.
Oliver Velez, author of Strategies for Profiting on Every Trade in 5 Tactics That Beat the Market.
I am going to show you how playing a shorter time frame can bring you closer to becoming profitable, not just on a year-by-year basis, but on a quarter-by-quarter basis, by a month-by-month basis, and at times on a day-by-day basis.
Alan Farley, author of Master Swing Trader in Predicting Market Trends.
What is it that traders don't think about when it comes to the time side of the spectrum? Number one, they don't think about time itself. They don't think about the impact of time on the price chart and how price, the other end of the equation, moves in respect to time. They don't realize the ways that time impacts whether or not they're going to make money.
Jeff Cooper, author of Hit and Run Trading in 7 Setups That Consistently Make Money.
This isn't a game of proving how smart we are, but rather of proving how well we can observe and respond to the final arbiter. That's price.
All courses are supported with online manuals, so you can see the charts up close and have a valuable resource you can refer to again and again. To access the manual for this course, go to traderslibrary.com/trade secrets. To make sure you get the best price on these profit-boosting DVDs and all of your other trading resources, go to traderslibrary.com. And now, Martin Pring in Technical Analysis for Short-Term Traders.
One of the things which has impressed me over the years, and the more I study charts and technical analysis, is that psychology is very, very important in terms of determining price. So the prices in any freely traded market are determined by the attitude of all market participants to the underlying fundamentals. It's not the fundamentals themselves which I think are important, it's people's attitude towards those fundamentals. Garfield Drew, a well-known technician in the 1940s and the 1930s, said people don't buy stocks for what they're worth, it's what they think they're worth. And that, again, emphasizes that point that the psychology is important. So when I'm looking at charts, I used to look at lines and things and patterns. What I try and do now when I look at charts is to look at those same concepts, but try and figure out what's going on under the surface with the underlying psychology. And I think if you can get some idea of that, which we'll look at some aspects of that later on this morning, you'll get a better feeling for when that trend reverses and when those charts are going to work and when those charts are going to fail. So a trend is a trend is a trend. That's an old expression we had in technical analysis. So we always assume that the prevailing trend is in existence until proven otherwise. Also, a lot of people think that you can predict where prices are going to go, but there is actually no known technique for determining the duration and the exact magnitude of a price move. There are certain techniques we can have, which like support and resistance, which we'll talk about this morning, price objectives, some price patterns and so forth, which give us a sort of an idea of where prices might go, or give us an intelligent place for expecting where prices will go. But there's no known technique for consistently forecasting exactly where a price is going to go and exactly on what date it's going to get there. All we can do is recognize a change in direction, and sometimes that can be difficult enough. Also, it doesn't matter what time frame you're following, the principles of technical analysis remain constant. And in my presentations, I often show long-term charts, and I show daily charts and intraday charts. And sometimes, people are interested in the intraday stuff and not interested in the long term. But the point is that the principles of interpreting these charts are exactly the same. The only difference is the longer the time frame, the greater the significance of the trend that you're monitoring. So the principal difference then between day and swing trading and other forms of trading or other forms of technical analysis is, once again, it's the time frame. When you get a signal on an intraday chart, an hourly chart or something, it has nowhere near the significance as if you are looking at a monthly chart or a weekly chart. But it still has significance, but it's only for a few hours as opposed to a few weeks or a few months. And it doesn't matter what security you're following. The principles of technical analysis remain constant because, once again, price trends are determined by psychology, and human nature is more or less constant, whatever security you're following. I often get people who come up and say, well, have you got anything on Forex? And I say, yeah, everything I do is on Forex, because there's no difference between Forex and stocks. There's no difference between stocks and commodities, no difference between commodities and bonds. It's all the same. The only difference, of course, is that some markets and some stocks are much more volatile than others. Like mining stocks are very volatile because their earnings are difficult to predict, compared to, say, utilities, where the earnings are fairly stable and they have a sort of a growth path. So there the volatility is much less, but the principles are the same. One of the most important things, I think, is when we get into any trade or any investment, we always look up. In other words, we're thinking about how much money we're going to make. We don't think how much money we could possibly lose. And I think it's much, much more important to look down right before I start to look up. So the first trading objective is to preserve capital. Not to make money, but to preserve capital. So trading rule number 1 is cut losses quickly and let profits run. And I'll give you an example here. Here we have a trade 1 where we start off with $100 worth of capital, and at the end of the first trade we've lost $50, we lost 50%. So we end up with $50 for a 50% loss. Then the next trade we make 50%. And then as we move on, we make 10% in the subsequent 3 trades, which gives us a total of 80%. So we lost 50% and we made 80%. So you'd think we'd be way ahead of the game. But mathematically, we're barely back to break even, because coming back from a loss is mathematically much more difficult than trying to make up those losses with subsequent trades. So if you can avoid making a big loss at the beginning, you're much, much further ahead. So in technical analysis, we're dealing in probabilities. We're never dealing in certainties. We're looking at that weight of the evidence and saying, okay, we've got 6 indicators which are pointing in the direction of a change in trend. Therefore, the probabilities of that change in trend are pretty good. But they may be 90%, but there's still a 10% possibility or probability that the trend hasn't reversed. We're never dealing in certainties, only in probabilities. So that's why we have to look at the weight of the evidence and look at several indicators to indicate a reversal. So what are the indicators? There's a whole host of indicators, but I'm just going to cover 6 widely differing topics today. So move that up. And I'll see, first one is basic technical principle of peak and trough analysis. Second one, support and resistance. Then we'll take a quick look at trend lines, a very simple technical tool, but I think is one of the most effective ones we have. Also a few ideas on how to place stops. And we'll look at some 1 and 2 bar price patterns. And finally, I'll talk a little bit about how brokers are a leading market indicator, not only for the long term, but also on the intraday charts too. It's absolutely amazing how brokerage stocks can help you lead if you're trading the stock market. Obviously not very good if you're trading currencies, but if you're trading the stock market, brokerage stocks are a great leading indicator, and we'll talk about that. So first of all, we'll discuss the idea of peak and trough analysis. This is a really basic technical tool, basically devised by Charles Dow over 100 years ago in the Dow theory. That's what the Dow theory is based on. It's really peak and trough analysis. The idea here is that you see a rising trend with rising bottoms and rising peaks. And as long as that is intact, this particular indicator is telling you that the uptrend is still intact. So rising peaks and rising troughs, all you can get from that diagram just there is that the trend is positive. Then we get to a point where we get a failed rally. It fails to make a new high. That does not indicate that the trend is reversed. That just indicates that there's a possibility that the trend is reversed. It's not until the price goes below the previous low that you now have a series of declining peaks and troughs, because this peak here is below that peak, And when you get below that trough there, you know that the next trough is going to be below that one. You don't know where it's going to be, but you just know it's going to be below, so that's the signal to sell. As far as this one particular piece of evidence is concerned, or this one technique, the peak-trough technique. Then we see the price come down a bit more, and now it's experiencing a series of declining peaks and troughs until we get to this point just here, and now you can see we have a series of rising peaks and troughs which are signaled because this low is above this low, and then as soon as you get above the green arrow here, that high is going to be above that high there. So that indicates now with that particular technique that we now have a series of rising peaks and troughs. And even though the price goes back below the breakout point, as you might say, at this point just here, the series of rising peaks and troughs are still intact. It's only if the price goes below this low here that the uptrend is thrown into some question. Or the uptrend, the new uptrend. And in this case here, it breaks up to a new high. Sometimes things aren't that simple because what happens is we get a situation where we get a series of rising peaks and troughs, and then at point X we now have lower lows, because this low just here is below that low just there, but the series of rising peaks are still intact. So that's not a full signal, that's just a half a signal. So what we have to do is to wait for the price to rally and then break below the low at Y, and now we have a series of declining peaks and declining troughs. If we didn't wait for that, then we may get this kind of a situation here where the price comes down, makes a new low, and then rallies up to a new high. So we didn't have a double signal here because we never saw the declining peaks. So what constitutes a legitimate peak or a legitimate trough? Well, here we're looking at a rally, and we can say we'll call that 100%. The rally is 100%. So we're looking at the retracement. And generally speaking, the rule I look for is a retracement between 1/3 and 2/3 of the previous advance. If it retraces 10% of the previous advance, that wouldn't constitute as a legitimate peak or a legitimate trough. But if it can retrace 1/3 to 2/3, then that suggests that that's a legitimate peak or a legitimate trough. And sometimes we don't get much of a decline that takes place. What happens is we get the rally here, and we get a retracement that's far less than the 1/3, 2/3 that I just described. But in terms of time, it amounts to quite something. So the rule I established here is that if we have a correction that goes sideways like that, then you say to yourself, well, it didn't retrace 1/3 to 2/3 of the advance, but it took 1/3 to 2/3 of the time taken to form the rally. So in other words, let's go forwards here a little bit. So in other words, here we might say it's 100% it took for the time taken to create the rally. In other words, let's say that's 100 minutes. Then this would be 33 minutes. If that's 33 minutes or greater, that's 1/3 of the time taken to complete the rally. There's the rally there. That's the time taken to complete the rally. So this must be more than 1/3, between 1/3 and 2/3. Here's some examples in the marketplace. We're looking at the S&P Composite, and I'm looking at a 15-minute bar chart. So there's a high, and now we can establish that we've got a low just here. And so we now have a new reference high here. And why is it a new reference high? Because there's the decline. Okay, that's 100%. And this is more than 1/3% of the, I'll go back there again. That's more than 1/3 of the retracement of that brown line. The green line is more than 1/3 of the length of the brown line. So that makes that a legitimate high. So that means that now we've got a downtrend which is still intact, because then we get another rally which retraces almost the previous decline. And as we move further, so the downtrend remains intact, and we get another new reference high just here, because there's the decline, okay, from the previous reference high, and there's a 1/3 there's the retracement, and then if we increase that, you can see that's more than 1/3 of the retracement of the previous rally. If it was 1/3, if it was less than 1/3, that final arrow up here would be down here somewhere. So that shows you that you had a 1/3 retracement of this decline just here. So that means that that now becomes a new reference high. So as we move on, of course, the price is continuing to come down. The downtrend is intact. And then the rally over here meets some resistance. And there's a possible reference low just there, because there's the advance, and here's the retracement, and then we make another 2 arrows, and you can see these arrows get below the previous low, so that's obviously more than a 1/3 retracement. Here's the rally, and there's the rally representing the 100%, the green, and then there's the retracement, which is more than 1/3. So the breakout occurs above the previous high, and it's above that high there, so it's a stronger breakout. And in fact, if you look at that, you can see that's actually a reverse head and shoulders. There's the shoulder, there's the head, there's the right shoulder. So now we have a new reference low. Just here we have the rally. The uptrend is intact. That's a new reference low. The price comes up and takes out that low, so a new downtrend is signaled. But things aren't always that easy, because what happens now is the price comes back up again and takes out this high just here. So we kind of have a bit of a neutral trend, and you see this rally here is above the previous high, and this sell-off just here is below the previous low. So we really have two benchmarks that we've got to look at to determine the direction of the true direction of the trend, because we obviously have some misinformation going on here. And those are the two benchmarks. Then the price, let me just come back to that. So the price then breaks above the upper end, the upper benchmark, and a new uptrend is signaled. And then as we move on, you can see that the price moves up very sharply. It moves into a trading range, and then the trading range is broken on the downside. So the question is that trading range really a legitimate trading range? And the answer is yes, it is, because there's the sell signal as it breaks. So is the trading range a legitimate one? Yes, it is, because here's our reference low here. And that's a reference low because the previous advance was just here. And when you put the retracement there and you put another couple of arrows, you can see that it was in fact more or less an exact 1/3 retracement of that previous advance. So that becomes a reference low, and obviously this decline just here is much less than 1/3 of the advance from here to here. So then we have to look at the time idea. Remember, we have two ways in which we could recognize a legitimate peak or trough. One is with the price retracement, and the other was with the time. So in this case here, what we're looking at is the time taken to create that trading range there, and then that should be 1/3, between 1/3 and 2/3 of time taken to create the rally, and indeed it was. So that's peak and trough analysis, and I think it's a lot of people ignore this at their peril, because peak and trough analysis can often give you some really valuable signals when you're trying to identify trend reversals. Probably in many cases much better than price patterns. And actually, in some cases, when you break out from a price pattern, you're actually breaking out, you're reversing the peak-trough progression in many cases. So the second thing I'm going to cover is support and resistance. Support and resistance are, I think, terms that are often misused. People sometimes say support when they mean resistance, and sometimes say resistance when they mean support. In Edwards and McGee, the classic text, they define support as where a declining trend can be expected to halt temporarily due to a concentration of demand, and resistance where an advancing trend can be expected to halt temporarily due to a concentration of supply. So support and resistance areas are not predictors of where prices will reverse. They merely indicate possible or probable points. So there's an intelligent place. If you can identify a support level or resistance level, it's an intelligent place for expecting prices to reverse. And then you have to go to other indicators to help you build up a case that that trend is in fact going to reverse. So here we see a declining market or a declining price, and one of the first principles of determining about support and resistance, or where they might arise, is previous highs and previous lows represent potential support resistance areas. So previous low is a good point to expect support. So in this case here, what happens is that the price rallies and then falls below the support. So temporarily it holds as it comes down to this previous low, but then as it comes up and rallies, then because the trend is down, it breaks that support level. So obviously a support level is not guaranteed every time to reverse the price. It's just an intelligent place for expecting the price to hold and reverse. And you have to look at your other indicators to help you determine whether or not that support is likely to hold or not. So there we have the support being violated. And in this case here, the price comes down again. So there's a previous low at this point just here. That's an intelligent place for expecting the price to experience a bounce at B. In this case here, it doesn't, and it falls a bit more. And when we get to C, so obviously C is at the bottom of this chart, so that's going to be a fantastic support level. We know that right away. So that's our new support level at C, and you can also see from the principle I was outlining that that is a previous low because we've got a bit of a rally going there. So as we move along, so once again that support level holds, and we can draw a line at the two rallies there because one of the other principles that we have to hold is that support reverses its role to resistance on the way back, up. So it's just like falling through a floor. If you fall through a floor, that's support. When you try and come back up again, that floor now becomes a ceiling. It's the same thing is true in the markets, that the resistance, what was previously support, is now resistance. And so when the price breaks above that resistance, you have to say to yourself, well, where's the next intelligent place for expecting the price to find a rally peak? And that would be where we had previous support at A. And the greater the support was at A in the past, I mean, that's nothing terrific. But let's suppose the price had come down here 6 or 7 or 8 times. That would have represented very, very important support. And in that case, that would increase the significance of that support level. The more times it's been touched or approached, the greater its significance. So here again, we have the support, and that would be an intelligent place for expecting the price to find some resistance. And indeed it does, because I obviously fixed this example. Another place that we might expect to see some resistance would be at this high here, because previous highs and previous lows represent potential support resistance levels. So in this case here, the price rallies up, and we find that, once again, support reverses its role to resistance on the way up, and on the way back down, former resistance reverses its role to support. So in this case here, we can extend the line. It's now green because it represents support, because the price is above it. And that was, again, an important support level. So resistance reverses its role to support on the way down. So where are support and resistance points likely to develop? Well, we've already discussed the idea of previous highs and previous lows. Because when you get up to a previous high, people who had taken profits there before say, okay, well, I missed that opportunity. I think I'll sell at this point again. So that becomes an important pivotal point. The upper and lower area of gaps often represent crucial support and resistance points. And gaps are an emotional point on the chart. And that's where you have a vacuum where the price jumps up for the next bar from the previous bar, or jumps down. Gaps are emotional points on charts. And emotional points on charts tend to be potentially very important support resistance levels. And a third possibility is the retracement points of previous moves. Something like a 50% retracement move is often a place where you could find support or resistance. Or Fibonacci retracement levels are another possibility where you could find support resistance levels. So could a 1/3 retracement or a 2/3 retracements. Obviously, nothing is guaranteed, and you can always look back and say, okay, well, that was a Fibonacci retracement because it was 61.8 or whatever it is. But you never know for sure. It's just an intelligent place for saying, okay, it's retraced 50% of that advance, and quite often when it retraces 50% of the advance, that's at a point where we'd expect to find support. So we're just looking for intelligent places all the time. But I think the upper and lower area of gaps, or if you have a very sharp 1 bar day or an hourly bar, which is very sharp, and it comes back down again, it's kind of an exhaustion move, that represents an important potential psychological point on the chart, which again is a potentially important support or resistance area. And I'll show you a couple of examples of those later. Third thing I'd like to cover is trend lines, obviously a very basic concept. But I think, if I was going on a desert island, I'd certainly take a box of trend lines with me, because I think they're a really very, very useful technical tool, far more useful than moving averages. Moving averages, unless you're taking a long-term moving average, tend not to be too reliable. And when I say long-term, I'm talking something like a 12-month moving average or a 65-week exponential. Those are two of my favorites. And they work reasonably well a lot of the time, but they're far from infallible. But a trend line, I think, especially a good, solid trend line, is a much more significant technical tool. But that's just my interpretation. So the idea here is to draw a trend line. You connect the first peak to the second peak and extend the trend line. And then, of course, when the price breaks above the trend line, that's the buy signal. I say the buy signal, but I really should not say it's a buy signal, because sometimes when a trend line is violated, the price goes sideways in a sideways trading range, and sometimes it reverses direction. So there's always usually a change in trend, but you don't know whether it's changing from down to up or down to sideways. Sometimes if it occurs when a price pattern is being completed, then you get some indication that it's a reversal. And sometimes when you get the momentum characteristics in the right combination, that will indicate that the trend line break is going to be a reversal type. But generally speaking, we don't know until afterwards whether it's a reversal break or a change in trend. But what it does tell us is that the downside momentum is dissipated, and you can either expect the price to go sideways or you would expect it to reverse. A lot of people draw trend lines like that. And it's not a trend line, of course, because it doesn't touch anything. And a lot of people are very careless when they draw trend lines. And I find myself doing it occasionally, and I have to go back and look at it and say, that's not touching anything, it's not a trend line. Because a trend line is nothing more or less than a dynamic level of support or resistance. And if it doesn't touch anything, then it's not representing a resistance, in this case, a resistance level. Uptrend line, connect the final low to the second low, and then extend the trend line, and the trend line break is the sell signal. Well, once again, it may not be an actual sell signal. It may be that the price goes sideways in a trading range and then resumes its uptrend at a slower rate, or that it goes sideways and then comes down, or that it comes down straight away. All you know is that the upside momentum has dissipated. So here's an example of a trend line, but it's not a trend line, because a trend line has to touch 2 points. And this trend line only touches this point just here. It doesn't touch that point there. So it's not a true trend line. And if you're basing, monetary decisions on a trend line, if you're going to go short based on the fact the trend line breaks and you've got some other evidence, you better make darn sure that that trend line is drawn accurately so it reflects the underlying trend. And that's an important point. When you're drawing a trend line really should reflect what the underlying trend is. So there are 3 rules that I have for determining the significance of a trend line. The longer the line, the greater the trend being measured, and therefore the greater the significance. So if you're drawing a trend line on a monthly chart, it's a very significant trend line. If it's on an hourly chart or a 10-minute chart or a 1-minute bar chart, it has nowhere near the same significance as if it's on a daily or monthly chart. The second one, and I think this is the most important determinant of significance, is the more times a line's been touched or approached, and I use the word approach, the greater its significance as a dynamic support or resistance zone. So the more times a trend line has been touched or even closely approached, the more times it's turned back, the downtrend, the declines, if it's an uptrend you're looking at. So the greater its importance as a dynamic support level. I say dynamic because, when we think of support levels, we think of numbers and horizontal levels. Whereas with the trend line, it's moving up. So the level of support keeps changing as the line moves up. So therefore, it's a dynamic level of support or a dynamic level of resistance. So a trend line has to be touched twice. That's a minimum, as we just discussed. But if it's been touched 5, 6, 7, or 8 times, then obviously that's a much greater level of support or resistance. And therefore, it's a much more significant trend line. And the third rule is the steeper the angle of ascent or descent, the less sustainable the trend, and therefore the less significant the line. So a very steep trend line is likely to get broken very quickly. So therefore it doesn't have much significance as a shallow line. I'd like to spend a little time talking about the placement of stops. And as I mentioned before, what we have to do is we have to manage our losses, because if we're going to take big losses, then we have much more difficult time coming back from those losses. So a key rule, I think, is to run scared. Before you get into a trade, look over your shoulder and say, well, what's it going to cost me if the market goes against me? And what's my potential reward? And that should be, I think, at least 3 or 4 to 1. So the number one decision when entering a trade is to know where you're going to get out if the market goes against you. And that means setting stops ahead of time and changing them when the market changes its mind, and changing them, in other words, when it's appropriate to change the stop. So the advantages of placing stops. First of all, what we're doing is we're mentally preparing for the worst. We're mentally rehearsing what's going to happen. And in his book on Market Wizards, Jack Schwager talks about some of the characteristics of great traders. And you find that all these great traders mentally rehearse what's going to happen before it happens. Because when it happens, they're going to get emotionally involved. In other words, let's say stock comes, you buy a stock, and you get you're expecting good earnings and you get bad earnings, and so the stock starts to sell off, and you weren't expecting this. So you're not mentally prepared for that bad news. If you had to stop in the market, you could say, okay, well, the market, when the price goes below a certain support level, then I should be getting out. And I'll put that stop in ahead of time because I can look at this thing objectively. Whereas if you're not putting the stop in and the price starts to come down on an unexpected news, you're going to think, well, maybe it's going to come back and I can get back a little later or something, and you can make some irrational reason as to why it's going to come back or why you shouldn't get out. And that's the way that small losses can turn into big losses. So if you've mentally rehearsed and said, okay, well, if the price goes below X, that means that the assumption that I made that the trend was positive is no longer in existence, and that would change the whole technical picture, and I should be getting out. In other words, if the evidence is bullish, you want to buy. But if the evidence changes to more to a neutral or bearish a bearish side, then you want to be out. There's no reason to be in that particular thing, except you think you should be in it because you're owning it. So that is absolutely irrelevant. If the trend has changed, there's no longer any reason to be in that particular trade. So mentally preparing for the worst is very good because it will also remove a lot of emotion from the trade. And the most important thing about trading is that you want to be as objective as possible. And another characteristic of good traders is that they don't go into the trade so much for the money. Obviously, the money is nice to make, but it's more for the challenge of beating the markets. And if you have it going for the challenge of beating the markets, then obviously you're going to be much less emotional than if you're looking at profits, and that's your number one objective all the time. So by putting in a stop, you can make a decision in a much more balanced situation. Like I was saying before, if you say to yourself, okay, well, if the price goes below a certain level, it's going to break this trend line, it's going to complete this price pattern, so on and so forth, then that will tell me if it breaks that particular level, that tells me that the trend is no longer positive. So you can make that decision before you get into the trade because your money is not committed. As soon as you commit money, then obviously you're committing emotions. So if you can make the decision, I'm going to get out if it gets below that certain point, ahead of time, when your emotions are in better balance, then you'll be much better than trying to make that decision when the news goes against you and the price starts to come down. Then you're going to be panicking and not knowing what to do. Or you won't panic, you'll panic late. It's always better to panic early, of course, but the thing is, if you put a stop in, it's automatically taken care of when you're in a more balanced state of mind. And also a correctly placed stop is usually executed at a better price, because if you decide when that bad news comes out that you want to sell the stock, you obviously got that time lag between the time you make the price, when the price is coming down, when you make the decision, you get to the floor, call your broker or press a thing online. It's going to take quite a while to get that order executed, and in the meantime, the price could be down quite a bit. So if you place the stop in ahead of time, you're going to be executing. It's a market order at the time that the price hits the stop. It doesn't always guarantee you, of course, you're going to get a better fill. If you get some economic number comes out and what was previously a liquid market becomes totally illiquid, nothing's going to help you in that kind of a situation. But generally speaking, in most situations, you'll get a better fill by deciding where that support level is and then placing your stop below that. So that's an important thing, is liquidation of long positions. The best point to place a stop is below support, and when you're covering a short one, you put your stop above resistance, not at the support level or not at the resistance level, but below the support or above the resistance. So here's a little example here. This is a December corn. It's a 10-minute bar. And the idea here is that we've got you can draw a trend line just there, and the trend line is approximately the same area as the moving average. That's another interesting point. A moving average is like a trend line in many respects. It's a dynamic level of support or resistance. And so if you get a good moving average, it represents a good potential support resistance zone. So if you can combine a moving average with a trend line, then you've got two pieces of evidence here. You've got the trend line, which is a dynamic level of support, and in this case here, you've got the moving average, which, let's assume this is a reliable moving average. That also represents a potentially important support level. So you've got the two things together. It's kind of like I often use the example of people in the construction business. If you use a piece of 2x4, that's okay, but if you use two pieces of 2x4, that's obviously going to make a much stronger, double the strength of the construction. So if you've got a trend line and a moving average in the same area, and as long as it's a reliable moving average, you've got two pieces of evidence that's really helping you to increase that confidence that that's going to be a good support level. So don't place the stop at support, because in this case here, if you placed it at support, you would have got stopped out. You want to place it below support, and in this case here, because the price didn't penetrate the support, you would have stayed in. Let's suppose you were contemplating going long. In this particular situation, here's a reverse head and shoulders pattern, and you would have placed the stop above the neckline here, because that represented the resistance and that represented the breakout point. So that looked pretty good to get in at that point, a good, nice little pattern. But just in case you're wrong, I shouldn't say you're going to be wrong. Let's say the market goes against you. That's much better, isn't it? Just in case the market goes against you, you need to have immediately, your initial decision was to buy here, but your previous decision was to say, well, where would I get out if that breakout takes place, and then it's a false breakout. And the idea would be that you want to place your stop under support. So in this case here, that would have worked out. You would have lost money by buying on the breakout, which is a perfectly legitimate breakout, but you would have limited your loss by the fact that you would have got out at a fairly close level to where you got in. One of the things that I'd be looking at here on a breakout would be to also say to myself, well, what are the oscillators saying? Because if I get a breakout here and the oscillator is overbought, then when you're in an overbought situation, the chances are the price is going to come the other way. So I would probably tend to ignore a breakout when a momentum indicator is overbought. In this case here, we don't have the evidence, but that's one of the pieces of evidence that I'd be looking at when I see a breakout, is to look at the oscillator and see what the oscillator is doing. Here's another example just here. And here we're looking at a sideways price movement. We're looking at resistance area. We want to place our stop above the resistance zone. Oops. Let's go forwards instead of backwards here. Place the stop above the resistance zone. Now we're long, so that we get the breakout here. And I always extend trend lines, because what was previous, as I mentioned before, what was previously resistance now becomes potentially support. So it's always a good idea to extend the trend line. And as you can see, it acted as a reasonably good support zone there. But if I, at this point here, I'm saying, well, okay, I want to take some profits, but where's a good place to be taking some partial profits? Well, at a resistance level. So if the price gets back up to here again, this is likely to be resistance, because at this point here, I know that was a previous high, and previous highs and previous lows represent potential support resistance zones. So I'm drawing a line up there and saying if it gets up to that point there, which is, I don't know what is it, about $2.81, that's because it's corn, that would be a good place to be taking some profits. Also, remember I mentioned about gaps being important potential support resistance zones. Well, here's the start of a gap, and the start of a gap is often an important potential support resistance zone because it's an emotional point on the chart. And you can see that already this opening of the gap came pretty close to where that rally peaked. So as we move on, you can see that the price did in fact get up to that resistance zone again. So if we had a stop in there to take some partial profits, it would have worked quite nicely for us. I'd like to spend a little time talking about some 1 and 2 bar price patterns because these really, I remember talking about psychology, and these 1 and 2 bar price patterns are an excellent representation of psychology in the markets. And from a trading point of view, they're really very nice because they give you a warning of a trend reversal at a relatively early stage. So all 1 and 2 bar patterns must be preceded by a short up or down trend because 1 and 2 bar price patterns can be consolidation patterns, but in most situations they're reversal patterns. So if you have a reversal pattern, you must have a trend coming into that reversal pattern that you can reverse. In other words, if you have psychology is bullish coming into a pattern, then the pattern is a bearish pattern, it's going to work. But if you're having a sideways trading range or something and you see one of these patterns, obviously it's not reversing the previous psychology. And often these 1 and 2 bar patterns represent exhaustion. They are also usually of a very short-term reversal phenomenon. In other words, what I look at a bar here and I'm saying, okay, there's a reversal pattern, that probably has significance for 5 to 10 bars. So if it's a weekly chart, that would be 5 to 10 weeks. If it's an hourly chart, it would be 5 to 10 hours. That's about as much as I can expect. 5 to 10 bars of reversal is about as much as I can expect from these 1 and 2 bar patterns. Sometimes they're positioned right at you see them right at the peak of a bull market or right at the peak of an intermediate rally. It's just, but it's not that the patterns have an effect for 1 or 2 years or for 3 to 6 months, and in the case of an intermediate reversal, it's just that they themselves have an effect for about 5 to 10 bars. But they may be positioned when some of these longer-term indicators are all ready to start to roll over. So the 1 and 2 bar patterns, in effect, if you're looking at a market peak, have the effect of being the first domino that you push over. And then maybe that pushes it over for 5 to 10 days, we'll say on a daily situation, and then that will push some of the shorter-term indicators, which have an effect for 2 to 4 weeks, and those will turn over, and that will have an effect on the indicators which measure the intermediate trend and so forth. So it's more or less sometimes a sort of an accident you see these 1 and 2 bar patterns at the ends of these intermediate trends or primary trends, because they in and of themselves only have a short-term effect. So they tend to indicate exhaustion where market psychology has reached short-term extreme. So I'm going to cover 3 patterns here today: outside bars, 2 bar reversals, and Pinocchio bars. So outside bars are reversal patterns that indicate a change in sentiment. The idea is that, as I said, these patterns must be preceded by a short-term uptrend or a short-term downtrend. So here's the uptrend, and that's an outside bar. It encompasses the trading range of the previous bar and then a little bit more. So the idea here is that the buyers are in control as we go through this rally here. And then as we move to the outside bar, the buyers are still in control because this is the opening price on the left, of course. They're able to push prices up. So at this point just here, everybody is continuing to be in an optimistic mode. But during the course of that bar, the sellers have the power to push the price lower, and they push it below the low of the previous bar. And the idea is it's better for this bar to close in the lower end of the trading range rather than the upper end, because if it closes in the upper end, it's still going to be an outside bar because it's going to encompass this bar here. But by the end of the bar, the buyers are still going to be in control because the price will be closing up there. So it's important for the close to be towards the halfway, or the lower it can be on that bar, the more significant the bar. And that's another thing about these 1 and 2 bars. 1 and 2 bar price patterns, you may get the characteristics of an outside bar or a 2-bar reversal or so forth. But some of these bars are created in a stronger way than others. It's just like, if you're taking a car, for example, an Edsel, which is not known for its quality as a car, is still a car. It's had 4 wheels, it had a steering wheel and an accelerator and so forth. But so does a Mercedes or a Lexus. It has 4 wheels, a steering wheel and so forth, an accelerator. They're both cars. They both have the characteristic of cars, but obviously the Lexus or the Mercedes is a much better quality car than the Edsel. Well, the same thing is true of these 1 and 2 bar patterns. They may have the characteristics, but some of them bring out the characteristics in a much stronger way. And for example, if this bar here was accompanied by very, very heavy volume, that would indicate that a big balance had been going on between buyers and sellers, and it would have a much greater significance than if there was really no volume at all going on here. So that's one of the, and I'll show you, talk to you about other characteristics as we move on. So not all these bars are created equal. So in other words, if you get more of the characteristics taking place in one of these bars than over here than in that one over there, other things being equal, that bar there has a greater probability of reversing the trend. And I say probability because there are no certainties in technical analysis. So in this case here, we have the outside bar, and like with regular price patterns, sometimes you get a retracement move like this here, and then the trend continues. So just because you're seeing an outside bar, don't expect prices necessarily to go straight down. They could go sideways for a couple of days or a couple of bars, and then resume their downtrend. Here's an example of an outside bar at the bottom. Once again, we have the trend is down. Sellers are very much in control. They come into this bar here on the opening, much lower than the previous close, start to push the price down, and then during the course of that bar, there's been a total turnaround between the balance between buyers and sellers because the buyers are able to push the price up and close in the upper half of the trading range. And again, this bar here encompasses this bar just here. So that's a very good example of an outside bar. And once again, looking at the quality of the signal, this is a very, I wouldn't say it's a nice decline, unless you're short, but it's obviously a pretty persistent and strong decline, indicating that there's a lot of, the sellers are very much in control, and therefore the psychology is very negative towards the end here. So that adds to the importance of the bar, the steepness of the decline, the previous decline, and the persistence of that particular decline. If it's only for 3 or 4 bars, it doesn't mean anywhere near as much as in this case here, where you come down for 1, 2, 3, 4, 5, 6, 7. This is the 8th bar. So that acts as a very strong contrast in the balance between the psychology between buyers and sellers with this very wide bar and following this persistent decline, because there was really no sign until we get to here that the buyers are now in control, because all the way through the sellers had been able to push prices lower. There's no example of any sort of outside bar just there. So looking at a couple of the characteristics that help improve the quality of the bar, first of all, the wider the bar and the wider the difference between the open and the close, the better. So here's an example of an outside bar. Nothing wrong with that, because this bar totally encompasses the previous bar. It opens towards the high and closes towards the low. I'm assuming that we have an uptrend coming into this bar. That's a much better outside bar because it's much wider. And a lot of times at market turning points, important market turning points, volatility increases. So the wider the bar, the wider an outside bar, the greater its significance, other things being equal. And this is a very, very wide outside bar. Now the other thing is, this is going to be very clever, I'm going to change where the opening and the closing price are. See, the closing price comes down here, and the opening price goes up there. So this is an even better bar now, because looking at the psychology, assuming that this is a reversal from an uptrend to a downtrend, here's the closing price. The price obviously opens here, so it would have gapped up. By the end of that bar, it's way encompassed this previous bar here, and the price is way down here. So in other words, this indicates that where the buyers were very much in control at the beginning of this bar, at the beginning of the bar, and were really enthusiastic and were really cashing in and licking their lips at the profits they were making on the long side, by the end of this bar, it was the sellers who were very much in control. So the wider the bar and the wider the difference between that opening and the closing price, the better it is. Also, the sharper the, as I was mentioning before, the sharper the preceding rally, or if it's in a decline, the reaction in a downtrend, the better. So in other words, here we have an outside bar following a little rally over here on the left, and there we have an outside bar following a much bigger rally on the right. Other things being equal, this bar here is stronger than that bar there because of this strong up move that precedes it. So there's a lot more to reverse. Here's a couple of examples in the marketplace. This is a 5-minute bar just here, and you can see we have a little uptrend here, and there's the outside bar with the price opening just here, higher than the previous bar. Buyers still thinking they're going to make some money at this point here, but by the close of the bar, the price is actually closing on the low end of that bar for a nice little reversal. But you know, in technical analysis, nothing is perfect. There are no certainties. And in this case here, we see another outside bar. It looks okay on the surface because it's preceded by a persistent downtrend here. The price takes out the low of this bar here and closes towards the high. And okay, the price went up for one more bar, but I regard that as a failure. It's not a successful, it's not what I would have expected. Because remember, what I'm saying is that when I get an outside bar, I expect the trend to reverse for at least 5 to 10 bars. And in this case here, it reversed to 1 bar. So that was an example of an outside bar failure. And I just put it in because in a lot of situations, the ideas, the concept will work, but you have to recognize that in certain situations, the concepts won't work because we're dealing in probabilities. And it may be one of the reasons why some of this stuff doesn't work sometimes is because you have to look at a trend above the trend you're following. In other words, it's a 5-minute bar. And if you looked at, say, a 30-minute bar or an hourly bar, you may find that the dominant trend is down. And if you're going to get a whipsaw, the time you're most likely to get that whipsaw is when it's a contra-trend signal. So that's why I would suggest that you never just look at one time frame. In other words, we're looking here at the 5-minute time frame. Look at that frame by all means if that's the time frame you're trading in, but always look above the time frame you're trading in to see what the more dominant trend is. Because if you're going to see an example of a trend reversal and it's going to be a counter-trend reversal, counter-cyclical trend reversal, then the odds are that that's likely to fail. So you always want to trade in the direction of what the dominant trend is. And if you're looking at a 5-minute bar, you really can't tell what the dominant trend is. You have to look further up. Here's another example, looking at the dollar-franc cross ratio, rate, and we see a nice decline here and culminating in an outside bar just here. And during this decline, there really wasn't much of an indication that the price was going to reverse. And then over on the right here, I've got outside bar here in quotes. And I've got it in quotes because this has the characteristics of an outside bar just here, this second bar. But it's not really, technically speaking, an outside bar because the price, the high, is the same level here as it is there. And remember, with an outside bar, it has to take out the high of the previous bar. This one here is an outside bar, but again, it's not a proper outside bar from the point of view of reversing the trend because the closing price should be down here below the opening price, and the opening price is down here. So that's not a very good example, although it has the characteristic because that trading range is greater than that trading range there. So this is more of the outside bar just here, but it doesn't take out the high. I don't care about that because when I look at technical analysis, I say to myself, I've got to interpret this stuff in a common sense way. And what is the real underlying psychology here? Rather than what's the rules usually work, but what's the underlying psychology? And the underlying psychology is definitely a change. Here we have an uptrend, and it's definitely, even though the price can't take out that high, by the close of that bar, the price is way below. So it has the flavor of an outside bar, and that's what I would go with, rather than saying, okay, it didn't technically take out that high of the previous bar. It has more the characteristic of an outside bar, and therefore I'm going to go with that rather than a strict interpretation of the rule. Now we'll take a look at the 2-bar reversals. These are my favorites because they tend to give you very sharp reversals in trend. indicate a dramatic change in sentiment. So the idea with the two-bar reversal is that it's two bars preceded by a sharp rally. And again, we're looking at the underlying psychology of what's going on here. So the buyers are very much in control here, and the price opens near the low of the two-bar reversal. Then it closes near the high. So in other words, during the formation of this bar, the buyers are very much in control because they're opening at the low and closing at the high. So there's not much argument looking at that particular bar and looking at the preceding rally that the trend is up and the buyers are in control. But then we get the second bar, where the second bar opens near the high and closes near the low. So what's happening here is the buyers are very much in control, very, very happy about the situation. The price opens here and moves a little bit higher. Maybe it moves a little bit higher than the previous bar. But at this point here, whatever it is, the buyers are still very optimistic, thinking they're going to see more of this as this bar starts to form. But by the end of the bar, the price comes back down and closes near the low, which is near the opening of the previous bar. So you've had a lot of activity here, because these bars are usually pretty wide, much wider than their predecessors. That's one of the things which gives you a characteristic, good strong characteristic. Another might be these two bars are accompanied by very, very heavy volume, because again, there's a very important battle that's gone on between the buyers and the sellers. The other thing is that by the time you get to the close, everybody who bought during this period here, and again, once again, the higher the volume, the better, they're coming back, they're coming home with a loss. So there's a lot of potential supply overhanging the market at that point just there. When there's potential supply and the sellers are in control, then obviously prices are likely to come down. The other thing that's important about a two-bar reversal is usually it's a fairly dramatic reversal. The price comes up and then it comes straight down after the two-bar reversal has taken place. But sometimes you get like with a regular price pattern, you get a breakout and then you get a retracement move to the top of the pattern. Sometimes you're going to get a retracement move with the two-bar reversal, where in the next couple of days or a couple of bars, the price might come up to here or might come up to there. The idea here is if you're looking at the quality of the signal, once again, you're remembering that the two-bar reversal is a fairly dramatic reversal, what you don't want to see is a big retracement, because that's not in sympathy with the idea or the concept of a really good dramatic reversal in psychology. So we want to bring our resistance zone down. Say let's bring it down to just there. And so if the price then rallies back up to that resistance zone, that's a low resistance zone, and that's in sympathy with the idea that the two-bar reversal is a quick, sharp reversal in sentiment. If it can come up to here, that's not too bad, but when it starts to come up to there, obviously it's cancelling out any effect that you might have in thinking that this is a dramatic reversal in trend. So if you see the price move back up to here, it's not so good. It's better to be at a fairly low point. The other thing is that two-bar reversals, like with all these one and two-bar reversals, their extreme points tend to be emotional points on the chart. And remember what I was saying before about the support and resistance. If you get an emotional point on the chart, that tends to be an important potential support resistance point. So from a purely trading point of view, tactic point of view, if you're going to be shorting down here, you have to say to yourself that I'm going to have to place the stop above this high here, because that's where the resistance lies. So if this bar is too wide and you don't get much of a retracement move, then you have to make the decision of whether or not there's a better place on the chart where you could be placing that stop, because that could be a really expensive place if the market turns around and changes its mind. So from the point of view of the formation of the two-bar reversal, the lower the resistance line, the resistance zone, the better. Here's a two-bar reversal at a bottom, and here we're looking at the opposite set of circumstances, where we have a sharp decline, and we get two very wide bars, wide relative to these previous bars here. Just as at the high, the two-bar reversal should be relatively wide relative to the previous bars leading up to the two-bar reversal. So the price opens near the high and closes near the low. So in other words, what's happening here is you have the sellers in control all the way through here, and as we get to this bar here, so they accelerate their selling, and so we open near the high and close near the low. And then the second bar is the exact opposite, where it opens near the low, and coming into the bar, you think, well, the sellers are going to continue to push the price lower, but they're unable to, and then the price closes towards its high. So that would be a 2-bar reversal at a market bottom. And then just as we wanted a low resistance zone, in this case here we want a high support zone, the retracement level. We don't want it to be much below that point just there. Because if it is much below here, then it takes away the idea that the buyers are very much in control and that we're going to have a dramatic change in trend and in sentiment. So in this case here, it's actually quite nice that the price did come down here and retrace some of this ground, because if we're using this as our emotional point on the chart, as our support point on the chart, then if we were to buy this item up here, then we'd have to put our stop down there. That would be the logical point. But now we got the retracement move, so we can buy it down here, and our risk is only to where we buy it. So at this point just here, taken a little bit below that potential support level, emotional point on the chart. So a little bit of retracement is actually a good thing because it gives us a better risk-reward opportunity. But if it goes down too much, then it throws into question the 2-bar reversal. Here's an example now where the price is breaking above resistance, and it's breaking above with a 2-bar reversal. And this is a very powerful signal. And I see it happen quite a lot of times where you break above a trend line or a price pattern or something, and it looks pretty good on this bar here. But by the second bar, the price is reversed and come back into the body of the pattern, or in this case here, below the trend line. And that's very, very significant from the point of view of downside action, because first of all, the 2-bar reversal indicates a change in sentiment. Second of all, you're breaking above resistance. So as a lot of people are getting attracted to come into this, the dollar franc in this cross rate, attracted to come in on the long side. And so you get a whipsaw breakout. And the whipsaw breakouts, whipsaws are usually, I look upon whipsaws as an opportunity to make money rather than something to be feared. As long as I'm standing on the sidelines and I see a whipsaw, then I can say to myself, well, there's a lot of people who bought on the breakout of that trend line are now locked in here. So that's a lot of potential supply. And the fact that the price couldn't sustain itself through that trend line is again a sign of technical weakness. And quite often these whipsaw moves actually turn out to be 2-bar reversals. So in this case here, we had a little bit of a retracement move almost back to that extended trend line, which I haven't extended, and then you get a pretty strong decline following that. And that's often what you get with a whipsaw, is you get an above average type move when you get into a whipsaw situation. So if you're lucky enough to be able to recognize a whipsaw, like this one here, and then you can lucky enough to see a little bit of retracement, you could be shorting here with a stop above this emotional point just here. And that would have been a good potential risk reward. I was talking earlier about perspective. Because I think perspective is important. We were talking in terms of if you see a breakout take place and it's a counter-cyclical breakout, that tends to be a whipsaw move. So it's always important to look at a more dominant trend. In this exercise here, what I'm doing is I'm showing you a British pound with a 10-minute bar chart. And here we're looking at a nice little trend line here, and we get a breakout. And as we move on, we get a little hesitation, and a breakout turns to be a false breakout. So this is a 10-minute bar chart. The idea I'm trying to get across here is that you may be trading in a 10-minute time frame, but you also need to look at other time frames as well, because what's happening in one time frame may not be giving you a signal. I mean, there wasn't much of an indication of a signal that was going to be a false breakout just there. And even, especially at this point just here, it came back, and you could say, okay, well, it temporarily fell below this support level and below this trend line, and I might just hold on to this thing. And then before you know it, the thing has gone straight down. If you've been looking at a different time frame, so this is 10 minutes, and now we're going to look at a different time frame. This is an hourly bar, and this is the same exact British pound, same period. In this case here, there's a trend line I was drawing before. But in this case here, what happens is that the breakout turns to be a false breakout, and you can see it's a 2-bar reversal. So that's giving you a much stronger signal that this is a false breakout and prices are likely to come down. And when I uncover more of the chart, you can see, obviously, they did. So if you were looking at the 10-minute bar chart, you wouldn't have had that idea of a 2-bar reversal and something pretty strong happening, because obviously an hourly chart is going to be anything that happens on the hourly chart is going to be much more dominant than what's going to happen in the 10-minute chart. And on the hourly chart, we have a 2-bar reversal. Now, again, I have to recognize the fact that a 2-bar reversal in this case here, remember I was saying before, a 2-bar reversal should be preceded by a strong, sharp uptrend. Well, in this case here, that's just not the case. But what we do have is a false breakout signaled by the 2-bar reversal. So everybody who bought in this area here, at that point just there, is coming home with a loss. And that was also a false upside breakout. So it had made that one attempt to break to the upside and failed. So here's another example of a 2-bar reversal. This is a 5-minute bar chart of the S&P Composite. And you can see how you do have a sharp uptrend preceding this 2-bar reversal here. Opens on the low, closes on the high, and people think their buyers are still in control. But by the end of that bar, it's actually, technically speaking, an outside bar, because that high is above that high and this low is below that low. But obviously, the open and the close are also engulfing the opening and close of the previous one. So it's pretty strong 2-bar reversal there. Now I'd like to spend a little time talking about Pinocchio bars. Pinocchio bars give us a false impression about what's really going on. Just like the Pinocchio character has a nose, and as he tells lies, his nose gets bigger, so the Pinocchio bar has the same effect. So Pinocchio bar has two characteristics. One, it's interbar trading pushes the price through support or resistance, but the opening and the close don't go through that support or through that resistance. It's just the interbar trading. And generally speaking, the longer the false breakout, or the nose, the stronger the signal. So here's an example of what I call a Pinocchio bar just here. The idea that the price on here's the resistance level here, and then the idea is that the price pushes itself through the resistance level on an intrabar basis, but not on an open and close basis. So this just happens during the bar. It's kind of an exhaustion move here, where the buyers start to break, start to move when it moves above this resistance, get sucked in. Sellers become too strong for them, and then the price closes down below that resistance level. So everybody who's bought in here, of course, is locked in with a loss, and that potentially is not a good sign. This time, before, the resistance was at a horizontal level. In this case here, the resistance is represented on a dynamic way by the declining trend line. But the principle still holds that the price rallies on an intrabar basis through that resistance, that downtrend line, but not on an open basis. Here's the opening price, and not on a close, because the price closes a little bit below that resistance level, the dynamic level of resistance marked by the trend line. So once again, everybody who bought on the breakout of the trend line is coming home with a loss at the closing of that bar. And it's kind of interesting, because I think the false breakout above the trend line actually, some people say, well, why can't you draw the trend line after that, joining this peak here to the peak of this bar here? You could. But I believe that the trend line actually is actually more significant because it has sustained a false break above it than if it hadn't. I don't want to see too many false breaks above the trend line. But again, remember, the trend line is supposed to represent a dynamic level of resistance. So if the price can break above the resistance for a little while and then can't hold above the resistance, doesn't that increase the significance of that resistance level? And certainly from a trading point of view, it presents us with a great potential opportunity, because once again, this is a whipsaw. And as I mentioned before, whipsaws are often followed by above average moves in the opposite direction to the whipsaw, and the direction of the whipsaw here was up. So by shorting down here, you've got a relatively small potential loss, because once again, this is an emotional point on the chart. It's an exhaustion point on the chart. And emotional points on the chart represent potential support or resistance levels. In this case here, it's a potential resistance level. So if you wanted to go short, you could short it here or even here, and that would be the reference point, because you'd have two pieces of evidence that the trend would reverse. One is the price would go above the trend line, and the other is it will go above this resistance as marked by this emotional point on the chart. And as long as this nose isn't too big, then obviously your risk is not that great. Or alternatively, if you wanted to, you could short here and say I'm going to cover if it crosses above the trend line. It wouldn't be such a strong signal when it crosses above the trend line as when it crossed above here, but obviously on a risk-reward basis you wouldn't be having so much of a risk to take. So here's an example of a Pinocchio bar just here where the price breaks above this horizontal level of support, and then it bounces around for a few bars after the breakout to the upside just here, and then starts to resume its downtrend. So sometimes when you get these Pinocchio bars, you get the break above, you get the excitement with the sharp break, because often this bar here is much bigger than the previous bars. You get that excitement, and then things calm down for a couple of bars, and you're tempted to say, well, that really didn't mean very much. But it's amazing after maybe 2, 3, 4 bars that then this pattern here, this Pinocchio bar, begins to have a much more negative effect on the price. So here's an example where we can look at a previous low. We see a bit of a rally here, and you can say that that's a previous low, and it's a pretty wide bar. So that represents a bit of an emotional point on the chart, an extreme point there. So you could say that's a potential support level, and you could draw a horizontal trend line at that point just there. And as I get more price action, you can see that definitely was a low, so that definitely was a potential support level. Then what happens in this case here is the price breaks temporarily below the support on an intra-bar basis, but not the opening and the close. Therefore, that's a good candidate as a Pinocchio bar. And it would be possible, for example, to say, okay, when the price is back up here, if it gets down to here in the next couple of days, I'll buy it, and then I'll put my stop below this emotional point on the chart. And that would have been possible because the price did retrace some of the ground. Then as we move on, you can see what we get is an outside bar, strong outside. Well, it's an outside day because this is a daily chart. And so now we have two pieces of evidence that the trend is reversed. One is this Pinocchio bar, and the other is the outside bar. And it gets even better because what I like to do on these 1 and 2 bar price patterns, which I haven't been doing up to now, is if possible, I like to be able to get some confirmation with some kind of a trend line that I could draw. In this case here, I can draw a really super trend line because you can see it's a very long line and it's been touched or approached on numerous occasions. So as a reflection of the underlying trend, this is a terrific line. And it also is emphasized by the fact that we got a whipsaw breakout just here. Remember I was saying about the whipsaw breakout, emphasizing the significance of a trend line. So this is a really terrific trend line. And it's being broken at a time just after the Pinocchio bar and just during the course of this outside bar. So when you get up to, we'll say, this point just here, you know that, or I should say just here, obviously this bar here at that point there is going to encompass this bar here. So even though this was a very strong outside bar by the close, during the course of the formation of that bar, you would have known that was an outside bar as the price crossed above that trend line and a couple of days after, 3 days after this Pinocchio bar. So that was a very, very strong signal because on the one hand, you had a break below this support indicating some exhaustion. And that was a whipsaw signal. And as I mentioned before, whipsaw signals are followed by above average moves. Then you get this outside bar that not only encompasses this bar here, but also encompasses that bar there. So there's been a very important change in trend here. And if I uncover more of the chart, you can see that it was followed by a pretty strong move. So when you get a whipsaw, you're not always guaranteed that you're going to have an above average move in the opposite direction to the whipsaw, but the chances are that you will. And so, as I say, whipsaws are something that you really should welcome because they can offer some really great potential profit opportunities. And then also with the Pinocchio bar, that represents, if I was to draw the trend line down here, that would represent resistance. So this is a Pinocchio bar. And once again, I'm using this as an idea of where you want to place your stop if you were going to go short, because that represents an emotional point on the chart. It represents a potential resistance level. So I'm going to expand the trading on this chart now. It's the same chart because we were over here and now we've expanded to here. And just to show you that in this particular instance here, that peak in the Pinocchio bar did represent good resistance. So if you had gone short and placed your stop above this resistance, then you wouldn't have made any money, but you wouldn't have got stopped out at this point here. Again, representing really that Pinocchio peak represents important potential resistance. So I'd like to wrap up by talking about brokers as a leading stock market indicator, because this is something I've been following for quite a long time, and in my weekly newsletter I'm often pointing to our subscribers to show them what the brokers are doing, because where the brokers go, the market usually follows. So why do brokers lead the market? Well, first of all, the stock market is a leading indicator for the economy. So stock market participants anticipate what's going to happen in the economy. They anticipate what's going to happen with corporate profits. But brokers get their profits from the financial markets. So brokers, in effect, discount the financial markets, discount the stock market. Because if you're a brokerage, if you want to buy a brokerage stock, you're going to say to yourself, well, what's the market going to do? And if you think the market's going to go up, then the brokers will make more profits. Because brokers make more profits when prices are rising. First of all, there's, generally speaking, in a rising market, there's more volume, and if there's more volume, there's obviously more commissions. People tend to trade more when they're making money than when they're losing money. Also, when there's a rising market, you usually get falling interest rates. And falling interest rates mean wider margins on bond and equity inventory. And third, when you get a rising market, you tend to get more IPOs, more underwritings as companies come to market. And that obviously increases the brokerage profits. So whereas individuals looking at individual stocks are discounting the economy, when you're looking at a brokerage stock, you're discounting future brokerage profits, which are determined by whether we're in a primary uptrend or a primary downtrend. And that's why brokers have a tendency to lead the market. They tend to be early cycle leaders. And you would think that probably wouldn't apply on an intraday basis, but it does. On an intraday basis, I've seen many, many times where the brokers might be breaking to the upside and the market's going sideways, and I'll show you some examples. And then you'll find that the market follows suit as to what the brokers are doing. So here's a long-term chart. We've got the S&P Composite at the top, and underneath we've got the XBD, or the Amex Brokers Index. And these arrows represent peaks in the S&P Composite. And the little green arrows, horizontal arrows, represent the kind of approximate lead time at these major peaks between the brokers and the stock market, just to prove that in the past, brokers have a tendency, they don't lead in every situation, but they tend to lead, and they tend to lead more at tops than at bottoms. The world's biggest broker, Merrill Lynch, can also be used as a vehicle for forecasting market trends. So once again, we've got the S&P Composite at the top, and we have Merrill Lynch at the bottom. And here we see Merrill Lynch is moving up very sharply, and the market is moving in basically a sideways trading range. And so that's a positive divergence between Merrill Lynch, which is moving up, and the market, which is basically moving sideways. And this was in October of 2005. So whenever you see the broker stocks moving up very sharply as the market's moving sideways, it's obviously because people in the who are buying brokerage stocks can't really wait to buy those stocks because they're anticipating a very strong market. And that's what happened in this case here. Once again, I'd like to see confirmation in a lot of these indicators. I like two pieces of evidence that the trend's reversed. One is the divergence between the Merrill Lynch and the S&P, and the other would be a little price pattern or a trend line. In this case here, we can draw a little bit of a base in the S&P, and it crosses the 200-day moving average at the same time it's breaking above this trading range. And so that's the kind of confirmation I like to see. Then as we move on, we see an opposite situation where you see the S&P makes a high here and a higher high here, and Merrill Lynch makes a high and a significantly lower high just there. That obviously is a negative divergence which needs to be confirmed. And in this case here, it's possible to draw two trend lines. The first trend line on Merrill Lynch is broken, is already broken at this point here. So then the confirmation would come when the S&P breaks this trend line here, because then we're saying, okay, the brokerage industry has a negative divergence, and what we need to see is that actual divergence taking place in the market itself. It's kind of like going outside and seeing some clouds up there, and they're dark clouds, and you think it's going to rain. That's the characteristic of Merrill Lynch breaking the trend line, but you don't actually know it's going to rain until you can actually hold your hand out and feel the rain. Well, you actually don't know the S&P is going to come down until it breaks, until it rains, and that means until it breaks that trend line just there. So then we move on a bit further, and at this bottom here, last summer, there really wasn't much of a sign of any positive divergence between the brokerage stocks and S&P. So you're not always going to get these signals at every market turn. But when you do get them, you really want to pay attention because it can be very significant. So now we see January and February up here, just before the February drop, the late February drop, early March drop, where the Merrill Lynch was making lower lows and the S&P was making making lower peaks, and the S&P was making higher peaks. And then we can draw our trend lines up here, and neither of the series has broken the trend line. So we got two great actionable points here. If Merrill Lynch breaks its trend line and the S&P breaks its trend line, then we got two pieces of evidence that the trend is reversed. Plus we got the other piece of evidence with the negative divergence on Merrill Lynch. And you can see that that's what happened. We got that very sharp drop, which we haven't had much of a follow-through at this point, but definitely it warned of trouble here. Didn't tell us what the characteristic of the trouble was going to be. That was going to be a short, quick downturn, but it did tell us that things were not right. Now we're looking at some intraday stuff, and again we're looking at Merrill Lynch, this time at the top, and now the S&P at the bottom. And the idea here is the S&P, Merrill Lynch is going sideways here, and the S&P is coming down. And if you want to look at the what's happening here with this particular low, the latest low that we're seeing, till I uncover some more on the chart, you can see that this low is the same level as that low. And then if we go down to the S&P, you can see that the current low is way below that particular low just there. So obviously the S&P is definitely underperforming what's going on with Merrill Lynch. So now we can draw a trend line on the on Merrill Lynch, and we can draw a trend line on the S&P. And at Wednesday's close, neither of these trend lines were violated. As we move along a bit further, you can see that both trend lines are now penetrated on the upside. And look at the Merrill Lynch. We don't get the volume for the S&P, but look at the volume on the Merrill Lynch. It's really tremendous. So the Merrill Lynch, by going sideways when the S&P was going down, was suggesting that the S&P break to the downside was actually a false break, and the next potential move is going to be on the upside. As we move on, you can see that both series are moving up again. And again, look at the volume on Merrill Lynch over here. Absolutely huge relative to what we saw on Tuesday and Monday. So now we see that the S&P is now coming up to resistance in the form of its previous high, but the Merrill Lynch has already gone through that resistance. So again, that's a very positive sign. But so what happens next is that Merrill Lynch goes sideways, and the S&P comes down because the S&P Merrill Lynch was above resistance at this point here, and S&P had a sharp rally, so it sort of needed a bit of a consolidation. But this looks like a pretty healthy consolidation if the concept I'm trying to get over is going to work, because Merrill Lynch is going sideways and the stock market itself is coming down. So that's a positive sign. So as we move along a bit further, you can see that we've already broken below that previous little low there on Thursday morning on the S&P, but Merrill Lynch has not done that. Merrill Lynch is actually above, way above, and the S&P is way below. So again, Merrill Lynch is showing really strong strength in the face of what is really a sharp intraday decline just here. Then we can draw another line here, which would be our breakout point on the upside, if our analysis is going to work, because that's the previous high there, and this is the previous high on the Merrill Lynch. So as we move on, you can see that, yes, indeed, we do break to the upside, and Merrill Lynch experienced some very, very, very heavy volume. So we could use this either as a trading vehicle to buy Merrill Lynch when it looked pretty good against the market, or you could say to yourself, there's something in the market that you wanted to buy, you didn't want to buy Merrill Lynch. You could say, well, this is a positive sign for the market. If the S&P starts to break above this high here, Merrill Lynch has already led the way, and that indicates a possible pretty strong rally. Actually, what it turned out to be was a breakout from a 3-month consolidation pattern just here. So by using the brokers, we can get a very good indication a lot of the time, not all the time, but a lot of the time, that the market's either going to move up, it's in a strong technical position, or very weak. And the more that the brokers are moving up, the faster they're moving up as the market itself is moving sideways, usually the stronger the rally that follows it. So that completes what I have to say. If you have any questions, I'd be happy to answer them.